Income Tax 2020. Earned Income Tax Credit. Come in, relax with Income Tax 2020. Earned Income Tax Credit. With regards to the income tax equation, we're going to be on the bottom half in the credits and payments section, remembering that we can break out our income tax equation into two halves, the top half basically being a modified income statement, the bottom half then being calculation of the tax and then application of the payments and credits. We here focusing in on the credits. The credits are typically going to be better than the deductions if you have $1 of credit, for example, versus $1 of deduction, because you're going to get that full dollar's worth of a credit. Whereas if you have a deduction up top, either above the line deduction or the standard or itemized deduction, you're only going to get a benefit in relation to the tax rate that will be applied. That's why the credits are going to be down here, which can be a little bit confusing because they're basically equivalent to a payment that is being made, and therefore they're going to be calculated down below. So they're not included when we calculate the basic income statement kind of top half portion, the taxable income, but they're going to be applied below because they're kind of equivalent in terms of a payment down below. We also have these two categories, and that's going to be because we have the refundable tax credits, and the earned income tax credit is one of those, or one of the main refundable tax credits, as well as the child tax credit. That means that it can take your liability basically below zero, and that means that you could get money back, or a refund, quote refund, but it's not actually a refund. If your tax liability is zero, it's basically like a benefit program at that point. And so that's why we have these kind of two categories, so we can do that calculation to think about the refundable portion and the normal kind of credit portion. So then on the second page of the 1040, we're looking down here on line 27. That's where the earned income credit will be, the EIC. Note that although the 2020 forms are out, or many of the 2020 forms are out, many of the instructions and publications have not yet been updated for 2020. We're going to be pulling some of this information from the publication 596, and we're going to get it from the 2019 information because it has a nice table, and then we'll show the updates or changes for 2020. So it'll look like this. We'll show this table for 2019, then we'll show the changes that happened so you can see the updated numbers for 2020. And you can find this publication on the IRS website at irs.gov, irs.gov, and you can type in publication 596. It should be updated for 2020 shortly. So what we're going to do is we're going to go through the table here for the earned income tax credit. This is the 2019 information, and then we'll update it, mainly these numbers here, for 2020, so you can see the changes for 2020, and that'll give us a nice overview. Now note that the earned income tax credit, although it applies to lower income individuals, is actually a kind of a complicated credit, as is the child tax credit, probably more so. The earned income credit is more complicated, but those two credits are both somewhat complicated due to the fact that they have a refundable portion to it. So you got to calculate the refundable portion, and then the earned income credit's going to have a phase out that will be involved in terms of your AGI. So once your AGI goes over a certain threshold, then the amount of benefit from the earned income credit starts to decrease. Now that's kind of common with other types of credits as well, but the phase outs are a lot lower, so it's a lot more likely that people are going to run into those phase outs at a lower time. The phase outs are also dependent a little bit more heavily on whether or not you have a child involved as well. So that kind of complicates things. And in order to get the earned income credit, you have to have some earned income. So if you have no earned income, even if your income is low or within the threshold to receive the earned income tax credit, you may not get anything, because the point of the earned income tax credit is to try to incentivize people to work. So let me see if I can recap the objective of the earned income tax credit, and then when we go through the rules for it, it might make a little bit more sense. So the earned income tax credit is a benefit type of program for people that might need the benefits. Therefore, it's going to be based on income, which makes sense that it would be tied to the income taxes, because that's when people report their income. And if you're going to give a benefit program, then basing it on income would make sense. Now, obviously, they also have the child that's going to be in there as well, because it's thought, of course, that if someone has a dependent child, then possibly they might need more benefit as well. And so that's going to have an effect on the benefit program as well. Now, one of the problems typically when there's going to be a benefit program that's tied to income level is that it makes a disincentive to work. So obviously, if you set up a benefit program, you want to provide the benefits to people that have less income, that might be the people that would need the income more. However, if people then work, then now their income goes up and their benefits go down. And in some situations, this actually happened where the benefit program benefits would actually be greater than the amount that someone could make while working, which is a really bad situation, because then you're basically locking someone into a situation where they're not working. So the earned income tax credit is designed to say, hey, we're going to give the credit by incentivizing people to work. So that means that the credit shouldn't disappear, basically, if someone's income starts to go up. In fact, the credit should go up as people have earned income, because that's what they're trying to incentivize people to do, right? So they're going to say, you have to actually have some earned income in order to receive the benefits, and then you're going to have an AGI limitation. So that means that we got kind of both sides on this phase in and then this phase out kind of thing. We have the normal type of thing with the phase out, meaning that if once people's income goes up above a certain level, then the income or the amount of the benefit starts to go down. You're going to lose sort of part of the benefit. That's a normal kind of phase out process. However, the phase out's a little bit more complicated because more people will be in that phase out, given the fact that it's going to be a low phase out because it's going to be a benefit program. Also, we have the complication of the child that's going to be involved in there as well, and that could complicate things in terms of calculating the phase out as well. And then the thing that we don't see as much is that incentivization for people to work is in that the credit actually goes up as your earned income goes up, meaning the income that you get from working goes up, because the idea is that will incentivize people to work, and it shouldn't basically completely eliminate the credit if people stop working, and it shouldn't, and it's trying not to have that incentive of people being in a situation that if they work, then they're actually getting less due to the fact that their benefits go down. So that's kind of the goal of it in essence. So economists kind of like the earned income tax credit because of that incentive kind of option. So here's what it looks like. So we got the, first you must meet all the rules in this column. So here's the column, we got to meet these rules. Your adjusted gross income, or AGI, must be less than, and here's all the caps, right? These are normal kind of phase out caps. So 50,000, and these are the 2019 numbers, so it's going to be changing slightly for 2020, which we'll see here. But let's just go through these numbers here so we can see it in this nice table format, and then we'll see the updated numbers, which will be somewhat, in the same ballpark. So 50,162 or 55,952 for married filing jointly. If you have 3 or more qualified children. So notice these caps are tied to dependents heavily as well. So we have, and not just dependents, but qualifying children. So 46,703, 52,493 for married filing jointly. If you have 2 qualifying children, 41,094 or 46,884 for married filing jointly. If you have 1 qualifying child, and then 15,570 or 21,370 for married filing jointly if you don't have any qualifying children. So you don't need qualifying children in order to receive benefits from the economic impact or the earned income tax credit, but obviously the threshold of income is higher if you do have children involved in the equation. Then 2, you must have a valid Social Security number by the due date of your 2019, same for 2020 return. Your filing status can't be married filing separately. So obviously the IRS is skeptical if they're going to give benefits based on income level of people then married filing separately, dividing their income level in half in order to try to take advantage of the earned income tax credit. So you can't get the credit typically if you file married filing separately. You must be a U.S. citizen or resident alien all year. You can't file Form 2555 related to foreign earned income. Your investment income must be $3,600 or less. So if you have investment income that's really high, that would indicate that you have a lot of money that's on the balance sheet, right? That means that you got money that's making money. And even though your income is low, it looks like you got money on the balance sheet, so you shouldn't really need the benefit program, which is what the earned income tax credit is designed to do. You must have earned income. So that's the key factor here that kind of differentiates it from other kind of benefit programs. It's actually requiring that you have earned income, not just that your income is below a certain threshold. Okay, then second, you must meet all the rules in one of these columns, whichever applies. So now we're looking whichever rule applies. Chapter 2, rules if you have a qualifying child. 3, rules if you do not have a qualifying child. And then 4 is going to be figuring and claiming your earned income credit. So 2, rules if you have a qualifying child. Your child must meet the relationship, age, residency, and joint return tests. Your qualifying child can't be used by more than one person to claim the earned income credit. So in those cases where you have like a joint custody type of situation or something like that, you can't use the same child to claim, the earned income tax credit in 2 places. You can't be a qualifying child of another person. And then Chapter 3, rules if you do not have a qualifying child. So if you don't have a qualifying child, remember your threshold to get benefits will be much lower, but your AGI would need to be lower to get the benefits at that point. And then you must be at least age 25, but under age 65. So you can't be the dependent of, and notice they're kind of skeptical. You can see kind of skeptical there of people trying to claim the benefit when they're basically possibly a dependent, right? They're saying you got to be over 25 in order to get the benefit if you have no qualifying children. So you can't be the dependent of another person. You can't be a qualifying child of another person. You must have lived in the United States for more than half the year. So then third, you must meet the third column in this column, and then you can figure in and claiming the earned income tax. Your earned income must be less than, and then we have our thresholds here for the thresholds. So notice this is for 2019. This is kind of the overall layout that you can think about. There's also an interview process on the IRS website that's useful, so we can take a look at that. Tax software is also useful to be working with, to be helping you to calculate the earned income tax credit. One for the qualifications, but also the tax software will help you with the calculation, which is obviously going to be a difficult component. Notice here, we're basically saying, does someone qualify or not? We're not telling you how much they're going to get from it. And obviously how much they're going to get is going to be dependent on these factors, and we're going to have tables that will be involved. So the best way to get that is typically to use the, some kind of software to help you out with the calculation for that. So then we're going to take a look at these threshold numbers and just update them now for 2020. So the 2020 numbers, these are the 2019 numbers over here. Now we have the 2020 numbers for single, head of household, or widowed, married filing jointly. So for 0, it's 15,820. For 1 dependent, it's our qualifying child, 41,756. For 2 qualifying children, 47,440. For 3 qualifying children, 50,954. And if you're married filing joint, then 0 qualifying children, AGI 21,710. 1 qualifying child, then 47,646, and 2 qualifying child, 53,330, and then 3, 56,844. Investment income limit is now at 3,650. Maximum credit amounts. The maximum amount of credit for tax year 2020 is, and notice it can be as high as 6,660 with 3 or more qualifying children. So 3 or more qualifying children, the credit could be as high as 6,660. If there's 2 qualifying children, the credit could be as high as 5,920. Again, what are the factors that will be involved? There's got to be an earned income factor to some degree so that the credit actually increases as your earned income goes up to some degree. And then there's going to be a phase out kind of component once your income goes over a threshold. So then the 3,584 with 1 qualifying child, and the maximum credit is only 538 if you have no qualifying children. So you must have earned income. So notice part of the earned income tax credit is that idea of the earned income. That's the thing the economists really like about it, because it's supposed to incentivize people to have earned income. So although it's quite complicated, because we haven't even gone into the actual tax calculation of it, we've just talked about whether or not you're kind of like in the range to qualify for it. So it's kind of complicated to calculate, but the plus side of it is then it hopefully incentivizes that earned income, and the earned income factor is what does that. So you must have earned income. This credit is called the quote earned income, end quote, credit, because to qualify, you must work and have earned income. If you are married and file a joint return, you meet this rule if at least one spouse works and has earned income. If you are an employee, earned income includes all the taxable income you get from your employer. So what is earned income then? Well, if you're an employee somewhere, then and you get a W-2 wages, then typically that's going to be earned income. Earned income includes all the following types of income. So 1, wages, salaries, tips, and other taxable employee pay. Employee pay is earned income only if it is taxable. Non-taxable employee pay, such as certain dependent care benefits and adoption benefits, isn't earned income, but there is an exception for non-taxable combat pay. So there, if you have combat pay, then you want to look into the exception there. If people are in the military, there's a lot of little exceptions that it's useful to make sure that you're picking up, because they could be advantageous. So which you can choose to include in earned income as explained later in this chapter. So 2, net earnings from self-employment. So if you have a Schedule C type of business, then you're paying basically self-employment tax. So that's, they should give you earned income on that as well. So that would typically be earned income. Gross income received as a statutory employee. So once again, you can use the EITC assistant here, and we may take a look at this in a following presentation. And this could answer some questions in like an interview type process about whether or not you qualify for the earned income tax credit. So we may take a look at that in the next presentation.